You're on YouTube right now looking for retirement answers. And you have a financial advisor, but you only talk to your financial advisor once a year when they call to update you on your portfolio. Those two things are not a coincidence. Let's just name what's happening here. You have that financial advisor and you're not neglecting your finances. You've been doing the responsible thing for years, saving, investing, not touching the money, increasing your contributions along the way. But somewhere along the way, the relationship settled into a pattern. Once a year, they call you, they walk you through how your accounts have performed, maybe mention a small adjustment or tell you not to be concerned about the current volatility in the markets, and then you hang up and you go back to your life. And it's fine. It doesn't feel alarming. It just maybe feels a little incomplete, hence you being here. So when something rattles you, a market drop, a headline, a birthday that ends in zero, or just one of those quiet Sunday nights when you start wondering if you're actually on track with what you're trying to accomplish retirement-wise, you don't call your advisor, you start searching YouTube. You look for someone who can explain things clearly. This episode is about that clarity gap, what the difference is between a portfolio update and an actual planning relationship. And hopefully we'll talk about why that gap tends to surface at the worst possible moments. And we'll even talk about what it looks like when that clarity gap is filled well. Here's where we're going with this. We'll start by separating two things that often get confused: portfolio management and retirement planning. They are intertwined, interrelated, but they're not the same thing. Then we'll talk about when the difference actually becomes visible. Not in those calm years like 2023, 2024, and 2025, but in the moments when they actually matter. After that, we'll get into what a real planning relationship looks like in practice, not what it sounds like in a pitch, but what it actually does and what it does for you. And then we'll close with a few honest questions worth sitting with, because this isn't about switching advisors. It's about knowing what you actually need to feel and be prepared for retirement. This shouldn't be a shocker, but portfolio management and retirement planning are not the same thing. They often get packaged together. We package these services together because they do genuinely overlap, but they address different questions and different concerns to some extent. Portfolio management asks, how is your money invested? How is it performing? Is it appropriate for where you're at in life? Retirement planning asks, does the structure of your financial life actually get where you need to go? Not just the balances, the income, the taxes, the timing, the contingencies, the things that change when life changes. A portfolio review can tell you that your accounts are up 10% this year. And yeah, that's useful information, but it doesn't tell you whether you're on track to retire at 63 or 64 or 65. It doesn't tell you how your 401k will interact with Social Security and Medicare premiums 10 years down the road. It also doesn't tell you what happens to your spouse's income picture if you die first. Those are planning questions, and they require a different kind of conversation, something different than just an annual call for sure. Neither style of advisor interaction is necessarily bad. I think both of them are necessary to some extent. The problem is when one substitutes for the other, primarily the portfolio management check-in substituting for retirement planning or being labeled as retirement planning. And maybe the real issue is that neither you nor your advisor really takes notice of it happening. So here are some things to consider just as you're kind of thinking through, what does my current relationship look like with my advisor? One of the questions that I ask myself is, when the market drops, do my clients know whether they should be worried or not? Generally, I end up being a sounding board for their concerns, and I am always happy to do that. What I found is that just giving some perspective, taking that historical perspective, but also combining historical market perspective with the plan that they have in place provides the most clarity and certainty about the direction that they're headed, regardless of what the markets are doing. when everything is focused on just the portfolio and the assurance is when markets decline, well, historically, they've always come back. Personally, I don't believe, and I have not found that that alone is going to reassure a client in the moment. The more reassuring perspective is when you can sit down with a client and show them the things that you've worked through together, the numbers that you've put together, the plan that you have in place, the plan that takes into account contingencies like market declines or unexpected personal events at home. Now, when someone turns 60, do they know when they can actually retire? Or do they just know what their balance is? This is real retirement planning. Helping somebody get to the point where they have an exit strategy, an exit from the workforce, helping them to feel confident about that strategy. And also, again, planning for market volatility. I'm never one to say that somebody should just go to cash to protect themselves from the market, because when you go to cash, you are just trading one set of risks for another set of risks. You're trading market risk for inflation risk, as just an example. So me personally, I try to look at different age milestones or milestones that help people consider how far out they are from retirement, because sometimes 60 isn't the milestone. Sometimes 5 years from retirement is the milestone, and that's regardless of age, whether it's 50 years old or 65 years old. Another huge consideration that does or should take into account what the portfolio is doing is this. What happens to a surviving spouse's financial picture when nobody planned ahead for it? One of the most common things that I see is a lack of true forward-looking planning, giving consideration to the variables that inevitably will happen, like one spouse passing away before the other. This isn't just a consideration of what is the lifestyle impact. This is also a consideration of what is the impact on finances? What is the impact going to be on taxes? Because especially the tax picture, this looks vastly different than when somebody is married and filing their taxes jointly. Likewise, you want to take into consideration things like when one spouse passes, their Social Security income goes with them. Maybe other types of income also disappear with them, and so considering what those income sources look like, but also what the tax picture look like, are really important things to be planning ahead for, so that when you are orienting a portfolio, when you are orienting tax planning discussions or estate planning discussions, you are thinking through not just what it's going to look like for both of you to survive together through retirement, but also to think through the inevitable, what happens when only one of you is continuing on? What does that picture look like? And that's far more important than just giving portfolio management guidance. Here's another consideration. What is the cost to someone when RMDs, required minimum distributions, begin and nobody warned them about the Social Security impact or the Medicare income-related monthly adjustment amount impact? This is a very important consideration, because oftentimes we think about hitting retirement and either needing to start our distributions from retirement accounts or knowing that we have enough in income sources to not have to touch them and delay for as long as we prefer. However, when you are able to delay drawing from something like a traditional IRA or the pre-tax money in a 401k or 403b, what inevitably comes with that is the eventual requirement to take a portion of that balance out every year. And right now that's at age 73, but for some people it will be age 75. So there are financial and tax consequences that occur when somebody has to take minimum distributions, potentially. The biggest one is the fact that Social Security may have been 100% tax-free at a certain income level, but then when the RMDs kick in, now Social Security is kicked up to being up to 85% taxable income. In addition to that, the combination of that increase of taxable Social Security income, the required minimum distribution itself, and any other income sources you might have can potentially trigger Medicare IRMAA, or income-related monthly adjustment amounts. IRMAA just becomes another expense coming out of that retirement income. And so thinking through the tax impact and the potential for an increase in the Medicare Part B premium, those are really important things to be thinking through, because those are financial consequences that can be accounted for and adjusted for and planned for if someone takes the time to do it earlier in the retirement picture or pre-retirement picture. The annual call works fine when nothing changes. The problem is that things change. That's life. Life changes. Things are constantly changing. And even when we get into a period that seems relatively static, where our income seems to stay the same, our expenses seem to stay the same, and life seems to be relatively stable and consistent, and that's when things happen, sometimes the unplanned for things. And so life is always going to throw us a curveball. Things do change. And to me, that puts emphasis on the need for something more than just an annual phone call. It means being connected to clients throughout the year, even if it doesn't mean contacting every client by phone or in a meeting multiple times through the year. It means reaching out to them in ways that let them know that we're available, emphasizing that we want to be one of the first people contacted when things do change in their life, because the impact to you, the impact to one of our clients of any major financial, medical, personal thing has an impact on that retirement plan. And we want to be able to adjust for that so that you can see how things are changing financially. Here's what I think a real planning relationship actually does. A real planning relationship isn't defined by how often someone calls you. It's defined by whether the plan that you have stays current with your life and evolves with it, adapts with it. In practice, that means a few things. First, it means the advisor knows your situation well enough to have a real conversation when something changes, not after a 2-week calendar delay and not by rereading your file from scratch every time you have a call on the phone. Secondly, it means the planning isn't just about the portfolio. Planning includes tax strategy or tax planning, income sequencing, Social Security timing, beneficiary alignment, and how all of those pieces interact with each other over time. Not as a one-time exercise, not as a 150-page deliverable document, but as something that gets revisited as the picture changes, as your life evolves. And thirdly, it means you're not the one managing the timeline. You're not responsible for remembering that a Roth conversion window might be opening up, or that your Medicare premiums will be set based on income from 2 years ago, or that your beneficiary forms haven't been updated since 2011. A good advisor is keeping track of that. An advisor who is involved with your life, who knows you, is keeping track of that. None of that requires constant contact, but it does require more than one conversation a year where the primary subject is portfolio performance. Think of it this way. A doctor who only calls you once a year to tell you your cholesterol is fine isn't really managing your health. They're reporting a data point. Health management means they know your history. They're watching for changes, and they're adjusting the approach before things get complicated. Retirement planning, in a lot of ways, works the same way. Now, I have some speculation in why people stay in these annual call type of advisor relationships. This is not to dog on any advisor out there or on any advisor-client relationship. It is just something for you to consider. If you are a current client of mine and you feel like this is the bucket that you're in, we just talk on the phone annually and that's it, I guess I would ask the question, is that because of me or is that because of your preference? Because I know that I encourage every client to at least meet via Zoom, but I love getting clients to come into the office so we can meet one-on-one, we can have that personal connection with nothing other than the desk between us. So if that annual call always feels professional and friendly, how would you ever know that something was missing from that relationship? To me, one of my roles, one of my obligations to clients, not a regulatory obligation, but an obligation that I feel as someone who believes in stewardship, is that I need to hold myself accountable to clients, but I also want to try to hold clients accountable to their own goals and priorities that they've expressed to me. And so sometimes the conversations get a little uncomfortable. We talk about morbid things like death. I have to bring up the fact that maybe they are underinsured for the third time in a row. Or I have to bring up the fact that they still don't have that power of attorney as they age into their 70s and potentially have a need for that attorney, in fact, being named. If it's 100% cordial and professional, that's fantastic. If it's superficial, just a bunch of niceties, and all you're really covering is portfolio management and what you did last spring, maybe you should be seeking a little more. And maybe that's what you're doing when you're online right now. Maybe you are looking for more without trying to actually begin a new relationship. Here's an interesting thing to consider. Can you ask for something you've never experienced? How do you even know what you're missing if you haven't gone out there and really looked into what's available? There are, well, I believe there's hundreds of thousands of advisors out there in the US now, and we all do things to some extent a little bit differently. Some of us do more than others. Some of us aspire to do more than others. Some of us have really large firms and take care of very wealthy clients, small client base dedicating a lot of time to each client. Others have very large or small firms with a lot of clients and not a lot of time to dedicate to each one. There's a wide variety. And then within that variety, you have everything from the 30-minute phone call advisor who calls all of their clients once per year to give them an update on the portfolio and maybe an update on markets, which personally I found to be a relatively boring conversation for the most part. And then you have advisors who are really trying to do everything for their clients, but also trying to make sure that their clients are getting everything done that is of value in their retirement and financial planning life. And so if you're not sure what you're missing in your advisor-client relationship, do some research. Does loyalty make it harder to question a relationship that's been fine for years? You know, another way to put this is, do you really want to dig deeper on something that on the surface doesn't seem to have any problems? And to me, the depth matters. And so I do strongly believe that loyalty is important, but I also believe that value for what we pay is also important. And maybe even more important than that is loyalty to yourself and your future goals, loyalty to your own values, loyalty to your family. And I know I said future self, but I'm going to say future self again, because when you don't dig deeper and maybe look for more and seek better, you're really doing a disservice to your future self. And so while I would be in the camp that says being loyal to something can sometimes make it harder to question that relationship when nothing seems to be going wrong, but one of the things that could be going wrong is missed opportunity for more comprehensive advice, missed opportunity for better advice, missed opportunity for a deeper relationship with somebody who wants to see you succeed, not just in achieving retirement, but succeed in doing well through retirement. Now, I have another question here. What is the real cost of switching advisors? And does that cost keep people from something better for themselves, better for their situation, better for their retirement? The real cost of switching, if I were to sort of summarize it as quickly as possible, is missed opportunity. Potentially it's a lack of clarity. And maybe more importantly, it's a lack of confidence in what you're doing. There are a lot of potential costs that are out there, but it would vary by the relationship that you have with your financial advisor and what kind of advice they're giving you, what kind of strategy they're helping you with creating or implementing or being accountable for. Okay, I like this question. Is there a difference between a great investment manager and a great retirement planner? And does that distinction matter at age 60? Yes, there's a difference. Because a great investment manager can get you great returns, obviously, or seems obvious to me. A great retirement planner, maybe they are not a great investment manager, but Maybe they know how to put together a portfolio that is aligned with your specific goals and your stage in life. And then they go well beyond that, looking at things like your retirement income, cash flow analysis, looking at your estate planning, whether or not you have all of your ducks in a row, your legal affairs in order in case something happens to you. On top of that, they're also looking at risk management, doing things like an insurance analysis, ensuring that you are not underinsured, because one of the large risks that's out there is financial risks, the risk of some kind of a loss. And that can have a great negative financial impact on somebody's retirement situation. Also, there's the tax planning perspective. There's a lot of value brought to a relationship when an advisor will give you some guidance on how to be more tax efficient, not just this year, but over the course of the rest of your life. That's not tax advice. I would always leave that to the tax professionals. In fact, I love working with the professionals in a client's life, trying to coordinate with the CPA and the estate attorney to make sure that any recommendations that we're making are aligned with the same guidance those other professionals are giving. I guess to summarize those last few questions, what I'd say is you don't really know what a planning conversation feels like until you've had one. There's a word I use with clients that I don't think comes up very often in financial services. And that word is accountability. Not accountability in the sense of checking up on you. Accountability in the sense of someone is tracking the moving pieces so you don't necessarily have to carry all of it alone. When markets drop, that person calls you before you call them, not to talk you down off the ledge, but because they already know whether you should be concerned or not, and they want you to have that answer quickly. When tax laws change, that person thinks about what it means for your specific situation and flags whether or not it's relevant to discuss. When you turn 63 and start seriously thinking about retirement, that person already has some context for you. The conversation doesn't start from scratch. It starts from where you actually are at that moment. And that's not a sales pitch for any particular advisor. And here's the honest question underneath all of this. If something significant changed in your financial life tomorrow, would you feel confident calling your current financial advisor? Not emailing them, not waiting for the next scheduled review, but giving them a call right now. If the answer is yes, that's a good sign. If you hesitated, or especially if the answer is no, that is worth paying attention to. So I don't want to get salesy here, but I do want to make sure that anybody watching this video, especially if you've watched it for this long, first of all, thank you so much. But this is not going to be a pitch. I just want to share some information about how Tide Pool Wealth is trying to be different, more evolved, a little more comprehensive, especially with new clients, but also with the clients that we have. The services any advisory firm offers, as you know, that company is a ship. Some ships are small and some are very large. The larger the ship, sometimes the harder it is for the ship to turn in order to be on a specific course. And we have, over the past couple of years, started implementing more initiatives to have that more comprehensive approach with clients. But it's not something that we do with every client. It may not ever be something that we do with every client, but it is increasingly something that we do with more and more of our current clients. So what does a first real planning conversation actually look like? And how is it different from a data gathering intake form? The first thing to know is data is important. We want to collect the data. We need the data. Every financial advisor actually has an obligation to collect certain levels of information about you and your financial situation. But real planning goes beyond that, trying to identify the goals, because some people's goals are different. Identifying values, because goals and values are typically going to have some sort of alignment. And then part of what I feel like is my job as a financial planner, financial advisor, is to create a sort of synthesis of the goals, the values, concerns and fears, the dreams and kind of future aspirations in the financial picture. And so the data gathering is an important part, but the first real planning conversation looks more like finding out more about you, finding out what your likes and dislikes are, getting a feel for whether or not we would be a good long-term fit, because you should not want to work with just any advisor. And likewise, we do not want to work with just any client off the street. You should be selective. And likewise, any firm that you are looking at, any advisor that you're talking to should also be selective. And their way of working with clients should be aligned with what you are looking for. This is exactly the kind of work I love doing, not because planning is exciting, sometimes it is, but because the clarity it creates, the results, the impact that it has on clients, and how it changes how they feel about their future, that is absolutely amazing to be a part of. So I guess we could take some action on some of the things that I've talked about here. First, think about the last time you had a conversation with your financial advisor that wasn't primarily about performance. Did it happen? What did you actually talk about? If you're drawing a blank, maybe that's a data point that you should tuck away and put a pin in. Second, make a short list of the financial questions you actually have right now. Not investment questions, planning questions. Things like, when can I actually retire? What will my taxes look like in the first few years of retirement? What will my taxes look like comparatively 10 or 15 years into retirement? What happens to my spouse if something happens to me? And then ask yourself honestly, does your current advisor know the answers to those questions for your specific situation, or do they just give you some general ideas? And third, if you're within 5 years of retirement, consider whether the planning relationship you have is built for where you're going, where you're headed, and not just for where you've been. Investment management got you here, but retirement planning is what gets you through the next 30 years. You do not owe anyone your future because they managed your past well. Loyalty is worth something, but so is clarity. Now, if you landed on this episode while searching for answers at 10 p.m., that's not a failure. That's a signal that you should pay attention to. It means you have questions that aren't getting answered somewhere else by somebody you pay to answer them. The good news is that the questions you're carrying are answerable. They're not that mysterious. They just need the right conversation, the right context, one that's actually about your situation and not just your account balance. Share this episode with someone who might recognize themselves in it. And remember, it's not about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Typo Wealth Strategy or Cetera Wealth Services, LLC. All examples are hypothetical in nature and for illustrative purposes only. The opinions contained in this material are those of Phillip Smith and not a recommendation or solicitation